Hello, this is Henry. Welcome to the November edition of the SMMT's European Car and Light Commercial Vehicle Production Outlook. As we approach the end of the year, it's worth looking at how we see 2013 turning out. We expect European production, excluding Russia, to reach 17.82 million. This will be equivalent to a growth for the year of approximately 1.2 million, equal to two-thirds of the fall in 2012 actually being recovered. 2012 itself was down 1.7 million on 2011. Well, where is this recovery in 2013 taking place? It's taking place in Spain, which has strong production growth at Ford and Citroën. It's taking place in Germany, where premium brand growth continues to be strong. It's taking place in Romania, where Dacia continues to grow and Ford has brought the B-Max into production. It's taking place in Serbia, where Fiat has new models in production. It's taking place in Morocco, where Dacia has new models in production, and we count Morocco now as part of European production, as most of the production in Morocco is for Europe. It's taking place in Turkey, where Hyundai, Renault and Toyota see strong production growth, and indeed here in the UK, where JLR and Toyota are having strong years. By contrast, there is still declining production in France, Belgium, Italy, Poland, Portugal and Slovenia. In a moment we'll look at some of the figures for Europe in graphical terms, but let's look at what we see as the highlights for the next few years in Europe. Well, we think that Europe will recover to its 2008 volumes on a pre-recession by 2015, but the 2007 peak will not actually be reached until 2017. This, of course, assumes that the EU recovery finally sets in next year and export markets remain strong. Germany will recover to 6 million units a year, and by 2018 it should actually have exceeded its 2007 production levels, although we don't think it will actually recover to 2011's artificial peak, where production was still being stimulated by scrappage schemes. We still see long-term losers. France by 2018 will be down approximately 27%, or 800,000 units on 2007. That's actually slightly better than we projected last time, but it's still pretty poor performance. Italy will be down approximately 29 to 30%, or 350,000 vehicles. That's slightly worse than we suggested last time, and it's even after taking into account the planned but as yet unstarted investment in Fiat's Italian plants. We have a more optimistic view of Spain's role within the major vehicle manufacturer strategies, and we actually see Spanish production largely recovering now. There will, however, still be an eastward shift in production. The Czech Republic will see production rise between 2012 and 18 by 12%, in Hungary by 80%, Romania by over 20%, and Turkey by nearly 50%. And of course, as noted before, Morocco is now part of Renault's European production network. Here in the UK, we have particularly optimistic views. We can see with Mini, JLR and Nissan new model programs coming on stream, the UK reaching as much as 2.2 million units a year by 2018, which would actually represent a growth of approximately 40% from the 2012 levels. You can see this growth across Europe, all countries in Europe in fact, including Russia, as shown on this graph. And that graph does tend to show that it looks as though the market will recover reasonably steadily and particularly strongly from 2015 onwards. However, the reality is that without Russia, somewhat different. You can see the Russian production accounted for by the green block in the middle of the chart taking an increasing proportion of Europe. We will turn in a moment to see what it looks like without Russia. Here we can see that without Russia the picture is somewhat less attractive, and this shows how without Russia Europe will still take until 2016 or 17 to recover to its 2007 volumes, i.e. just over 20 million units across the EU region plus Turkey. It is possible, however, that the situation could be rather worse than this, particularly if sales in the next quarter tail off and if the recovery in 2014 stalls or fails to materialise. We show this in the chart below, where we reproduce a number of the scenarios that we also have in our full production report, which is available on the SMMT's website. Here we can see the total European production line, including Russia, which is in blue. Below that, the European production total without Russia, which is the pink line. And you will see that the gap between the two is increasing over time, which highlights the importance of Russia to European production totals. And then we see three other scenarios, which we call scenarios 4, 5 and 6. Scenarios 1, 2 and 3 are detailed in the production report. We highlight 4, 5 and 6 because they are the worst case in our analysis. And it really is important to examine what might happen if one or other of these scenarios came to pass. And in particular, we think it's important for the European vehicle companies and policymakers to consider what would be the implications if scenario 5, or worse still, scenario 6, came to pass. This would involve production by the end of the period we look at still being below 16.5 million. And if that were the case, we do not believe that the current industry structure would be sustainable. We think that's a very important issue that still needs to be considered by the industry and policymakers as a whole. Let's look in a bit more detail at the falling sales and production volumes across Europe. In 2012, the EU 27 car markets fell to a 17-year low, and this continued in the first 8 months of 2013, with a further decline across most markets. This dampened the cautious optimism evident at the Frankfurt Motor Show. However, in September and October, sales were up 5.4% and 4.7% respectively. This, however, needs to be set against the decline in production across Europe between 2007 and 2012. Over that period, production has fallen by 3 million units in total. Fiat, Ford, Opel, Vauxhall, PSA and Renault in fact lost 3 million units combined. There were other losers too, Toyota, Suzuki and Seat in particular. But there was strong growth at others, at Dacia, Hyundai, Kia, JLR, Nissan and VW Audi. And this suggests that there is a new order for the vehicle manufacturers in Europe beginning to emerge. Most of the volume brands, in our view, face a long-run structural decline in Europe, as the value brands and premium marques continue to grow. And we ask the question, having lost between 500,000 and 700,000 units each over the last 6 years, can the volume VMs, i.e. Fiat, Ford, Opel, Vauxhall, PSA and Renault, ever really recover? Well, how are the vehicle manufacturers responding? Well, they are restructuring and refocusing their businesses in somewhat different ways. Faced with continued and rising losses, Ford, GM and PSA have announced plant closures. Fiat, by contrast, has reallocated production between its Italian factories. It's slimming down but not yet closing plants. It's bringing production back from Mexico to Poland, and optimistically perhaps it's planning to use Europe as a production base, including its Serbian and Turkish plants, for global supply for the Fiat, Alfa and Jeep brands. Its strategy, however, in terms of it being implemented, has been delayed somewhat due to financing restrictions ahead of the full Chrysler takeover. Renault has reached union agreement on cost-cutting in parallel with 3 interesting developments: increasing commitment to its French and Spanish production, adding Nissan car production to its European portfolio in France, and increasing production in Turkey and Morocco, but largely for European markets. GM and PSA have responded with a defensive alliance covering logistics, purchasing and indeed new models. All the benefits of this alliance are not yet fully apparent, and certainly we don't expect to see new models from the alliance before 2016-17. Interestingly, however, the scope of the alliance is being reduced, and we do wonder whether the company's strategies will in fact diverge, and the alliance may well end sooner rather than later. And we have to ask whether further cuts will still be required if demand and production falls again. And we think it's highly probable that Fiat and Renault will need to cut further into their fixed cost base. PSA, Ford and GM deny that they will cut further in Europe, but we wouldn't be surprised to see 1 or 2 more plants close within the next few years. In recent years, Europe has been underpinned with strong exports, and we want to ask the question again whether export markets beyond the EU can be Europe's saviour. Certainly the German and UK premium and luxury brands have been highly dependent on the US and Chinese market for recent growth. And today these markets have certainly held up, and the confidence remains high that they will be sustained in the medium term. However, for some European brands, their own production activities and expansion in NAFTA, South America, India and China is increasing, and these moves will actually reduce how much non-EU export demand can actually be met from European plants, especially at the volume brands. The Volkswagen Group, Fiat, PSA, BMW and Mercedes are all increasing capacity outside Europe, especially in NAFTA, Brazil and China, and JLR will soon be producing in China. Audi is building a new plant in Mexico, while Volkswagen, BMW and Mercedes are all widening their US production portfolios, and BMW is building a plant in Brazil. Renault Dacia production in Morocco is now competing with production out of European plants, and some of these moves will definitely harm struggling European factories. So in conclusion, we do see a sustained production recovery on the way, but we don't think it will be fully apparent before 2015, and we still think that the revival will be somewhat shallower and slower than post the 2008-9 collapse. The possibility remains that long-run European production volumes, excluding Russia, could still be below the 2007-2008 peaks. The implications of this have still not been fully worked out by the industry and the authorities alike. European vehicle manufacturing was not actually financially robust even in the recent boom years, and we continue to ask the question, can the major vehicle companies sustain their European production operations if these losses continue? Ford, GM and PSA have started cutting back their European operations, and although GM remains very committed to Opel Vauxhall and Renault is raising investment in France and Spain, Fiat is doing all it can to avoid plant closures, we have doubts as to whether these strategies will be sustainable in the long run. We think we will see further restructuring and capacity cutbacks, but the question is when and where will these happen? We ask the question again, will a major European name disappear by the end of the decade, if not before? It's worth noting in recent months we have seen strong reports of Dongfang of China taking a stake in PSA, and this could be the first stage in the eventual change of ownership of PSA. At the same time, the rising strength of the Koreans and Nissan and the enduring appeal of the German and premium brands should not be underestimated, and we think these companies in particular will play a much stronger role in European production in the years ahead. The pressure on the volume brands will only increase and will be impossible to ignore. All of this, as we've noted before, does not even take into account the potential impact of the Chinese, who are now appearing on Europe's fringe, but have yet to make their major moves into Europe. Thank you for listening. Details of how to access the full report are shown on the page in front of you now. Thank you for listening to this and indeed earlier editions of our Production Outlook briefing, and we hope you found these useful during 2013. There will be more of the same during 2014, and we look forward to talking to you then. Best wishes for the new year. Goodbye.